Yo, what's up everybody? It's AJ from Financial_Giant, and let's talk about Trump dropping a bombshell, a 104% tariff on Chinese electric vehicles. 104%, that's insane. This isn't just about cars, guys, this is about crippling China's entire manufacturing dominance. Trump wants companies to pack up and move production. And guess who's ready to roll out the red carpet? India. That's right, this trade war could be India's stock market jackpot. We're talking massive potential profits. So if you want to learn how to turn this geopolitical chaos into serious gains, smash that subscribe button, because on today's Financial_Giant, we're diving deep into how to profit from this tariff storm. Alright, so let's break down exactly what's going on here. Trump's basically saying, if I'm back in office, any electric vehicle coming from China is getting slammed with a 104% tariff. That's more than double the price. Now this isn't just some random threat, this is classic Trump negotiation tactics. He wants to protect American manufacturing jobs, and he's willing to play hardball to do it. Think about it. China's been the world's factory for decades, churning out everything from iPhones to Teslas at crazy low costs. But this tariff throws a massive wrench into that whole system. Suddenly, China's not looking so cheap anymore. Companies are now forced to make a choice: eat the cost of the tariff and watch their profits disappear, or find a new place to set up shop. And that's where India comes in. See, India's got a few things going for it. First, a massive, young, and increasingly skilled workforce. Second, a government that's been actively courting foreign investment with its Make in India initiative. And third, a strategic location that puts it right in the heart of Asia's booming consumer markets. So, while this tariff might seem like bad news on the surface, it could actually be the catalyst that pushes companies to finally make the move to India. We're already seeing it happen. Apple's been shifting some iPhone production to India, Tesla's been rumored to be scouting locations for a gigafactory, and these are just the big names. Countless other companies, especially in the electric vehicle and electronics space, are going to be looking for alternatives to China. And India is perfectly positioned to become the new global manufacturing hub. In check. Alright, so we've talked about the big picture, but let's get specific. Which Indian sectors are best positioned to ride this wave? First up, EV manufacturing. We've already mentioned Tata Motors and Mahindra, but keep an eye on any company involved in electric vehicles, from two-wheelers to buses to trucks. Next, auto components. Even if global automakers don't fully relocate to India, they'll still need parts. Companies like Motherson Sumi and Bosch India, which supply components to major automakers, stand to benefit. Battery technology is another no-brainer. The shift to electric vehicles is going to drive huge demand for batteries. Amara Raja and Exide are the big players here, but also look at smaller companies developing new battery technologies. Don't forget about capital goods. As companies invest in new factories and infrastructure, capital goods manufacturers like Bharat Forge and Siemens India will see increased demand for their products, and while it's not a direct beneficiary of the trade war, India's export-driven IT services sector could also get a boost. If global digital demand remains strong, companies like Infosys and TCS could see increased outsourcing from companies looking to cut costs. Finally, keep an eye on consumer durables. As the Indian economy grows, so will consumer spending. Companies like Dixon Technologies and Voltas, which manufacture everything from TVs to refrigerators, could see significant growth. Now I know you're probably thinking, alright Ajay, enough talk. How do I actually make money from this? Here's how to position your portfolio to potentially profit from this geopolitical shift. First, focus on EV and battery tech stocks. This is where the most obvious growth potential lies. Look for companies with strong fundamentals, a clear growth strategy, and a competitive edge in the market. Second, add exposure to capital goods and infrastructure. These sectors will benefit from increased investment in manufacturing and infrastructure projects. Look for companies with a proven track record and a strong order book. Third, keep an eye on export-driven IT. While the trade war might not directly benefit this sector, it could lead to increased outsourcing as companies look to cut costs. Look for companies with a strong global presence and a diversified client base. Fourth, consider mid-cap manufacturers riding the Make in India wave. These companies are often overlooked by large institutional investors, but they could offer significant growth potential as they benefit from increased domestic manufacturing. And finally, hedge with a bit of gold or global ETFs. While this trade war presents a huge opportunity for India, it's important to remember that global markets can be volatile. Adding some gold or global ETFs to your portfolio can help protect your capital in case of a market downturn. Remember, diversification is key to long-term investing success. Look, while this whole situation could be a game-changer for India, don't forget global markets are unpredictable. Currency swings, inflation spikes, even Chinese retaliation, these can all shake things up. Stay diversified, and keep watching those global cues. But here's the thing, the next time you hear about Trump, tariffs, and trade wars, don't panic. Think profit. This could be India's moment to shine on the world stage, and your chance to make some smart investments. If this video got you thinking, hit that like button, subscribe for more market-moving insights, and let me know in the comments. Which Indian sector do you think will benefit the most from a new trade war? Let's discuss.